Today, we're going to load you up on how to maximize your cash.
Brian, I am so excited about this because I love free money. I know that you love free money. And while it may not seem like this is free money, I'm going to argue it is. And if you're someone out there not getting it, not grabbing it, not taking advantage of it, you're missing out.
Hey, I've been saying for years, all my financial mutants, we kind of expect our money to go 3 to 5% greater than anybody else just because we're good with money. If you're not maximizing cash, you're leaving money on the table, and we've got proof today.
And I would argue if you're not maximizing cash right now, it's because you're just lazy. It's because you are not willing to go that extra mile to be the commander that your army of dollar bills needs you to be. But Brian, I think a lot of people fall into this trap. We saw an interesting statistic that kind of the status quo for a lot of folks is good enough.
Yeah, I think banks take advantage of the fact that there are some friction costs to changing, and there's a lot of loyalty to banks. And this number has actually gone up because I had previously, when we were talking about this in show prep, I said I think there is a stat out there that says bank relationships are like 16 years. But when Megan and Daniel were putting this together, we found actually, according to Bankrate, most Americans have the same bank account for an average of 17 to 18 years.
And it's because, we get it set up and we have it and we have our accounts linked to it and we have the automatic payments come out and oh man, changing it just seems like, it's just
sticky.
A nightmare. Why do I want to do that? But there's a reason that you want to do that. There's a reason that if you are just being lazy and you're not taking advantage of it, at this point in time, in this moment, there are some real dollars that you're missing out on. You may be asking the question, okay, how much am I missing out on? What am I missing out on? Check this out. If you think about the average brick and mortar right now is paying about 0.42% on their savings account across the country.
That's savings account. Any of you out there sitting on like $30,000, $50,000 in a checking account?
It's even worse.
You're actually probably getting zero, but this is a savings account at brick and mortar banks.
Yeah, so we said if you have a $30,000 amount sitting at a brick and mortar earning 0.42%, you get about $126 of interest a year. So that'll take you out for a nice dinner, maybe, right? Well, if you were to use an online high yield savings account, now you're talking about $1,200 in interest. That's 10 times more. And there are even better options out there like money market mutual funds that could have you bringing in over $1,400 based on present interest rate. So if you're not doing this, if you're not paying attention of it, you are literally walking away from free money.
Yeah, I would think about it in these terms, is that you could actually get in 1 month what most brick and mortar banks are paying for an entire year.
Yep.
So this is why when we are a 10-fold increase, you need to perk up, listen, and we're actually going to walk you through. Because I think what I was surprised when we were doing the show prep was that there are a lot of nuances that I think most people don't understand. And we're going to show you, hey, what should you do and what is the part so you don't get caught up in the hassle factor of making a lot of actions for not much benefit.
Okay, Brian. So the audience out there is saying, okay, I hear you guys. I understand what you're saying. I understand. But why would I keep cash? I mean, I'm an investor. I'm a financial mutant. I want to get my money working for me. What is the reason why I would hold on to cash? Well, we think there are a number of them. The first of which is no surprise. It's your emergency fund. If you're following the financial order of operations, Brian, do you have a thing that you can hold up to show them?
Oh, yeah. Here we go.
If you're following the financial order of operations and you want to get a free copy, you can go to moneyguy.com/resources and you get to step 4. That is your emergency reserve bucket. That is your rainy day fund that is going to keep your life out of the ditch. So at a very minimum, you ought to be holding cash so that you have it there for emergencies.
Yeah, any upcoming purchases, people ask me all the time, I have a house down payment where I think I'm going to be buying a house in the next 18 to 36 months, or I've got a trip or even an engagement ring. I'm always amazed at people thinking about if they're popping the question in that 18 to 36 months and they're like, should I put it in the market? I'm like,
No way.
You need to put it in cash equivalents, and we're going to kind of walk you through how to maximize that. And then I do cover, and we're not going to spend a ton of time on this today, but I do love, if you want to be a baby Buffett, step 8, once you get to step 8 of the financial order of operations, as Bo's already covered, there's actually opportunities to build wealth with cash as well.
Yep. And so, but if you are sitting there thinking, yeah, but man, guys, I'm a financial mutant. I've already said this. I'm going to do all these things, but I want my money to be working even harder. One thing that we would remind you of is for these types of purchases, for emergency funds, for purchases inside of the next 5 years, for having powder money, you want to make sure that it actually stays in liquid, readily available cash, because when bad things happen, they don't often happen in isolation.
Yeah, when it rains, it pours, guys. You've heard me talk about how bad news, volatility, unemployment, real estate getting crushed, they're all extroverts. They all like to hang on the street corners, smoking cigarettes together. So you need to pay attention. When it rains, it pours. Bad news typically doesn't happen in isolation.
And just to show you a very quick snapshot of this, look at unemployment rates from 1996 until now. You can see there's kind of ebbs and flows. Unemployment comes down and then it goes back up, and then it comes back down and it goes back up. Well, if you were to lay over here the bear market, you look at the 2002 dot-com bubble bursting. The market at that time was down 49%. Unemployment was at 6%. So you get laid off, and at the time you need to access those dollars, if you have them invested, the market just delivered a painful number for returns. In March 9th of 2009, the market was down 57%. Unemployment was 8.5%. And then obviously, one that we all remember is COVID. In March of 2020, the market was down 34% and unemployment skyrocketed to 13%. So you want to make sure that when you need those dollars, they are there readily available for you to utilize in an emergency.
And also another point with this, when it rains, it pours, is a lot of people, I fell in this trap. You guys have heard me. I've had my promise and prayer to, if I got through this moment of the Great Recession where I was relying on my home equity line for my cash. I was running so thin on cash because I was like, why do I need it? I have 6 figures that the bank is allowing me to have a checkbook as well as a debit card to, so I can just borrow off of my home equity line at prime minus, I think I had a prime minus a half, maybe prime minus 3/4. It was some great deal that made it almost pretty low access cost as well. But guess what? It was all a mirage, because when it rains, it pours. The bank said, just kidding. You had all that access to cash you thought you had. We're taking it all away because the stock market's down. Your house isn't worth what we previously told you. Guys, be very careful, because guess what? I saw an echo and I was like, oh no, here we go again. You think history does repeat itself, because Bo, show them the headline from the next slide. Bloomberg just came out with a headline. This is in the last few days. U.S. homeowners are tapping $9 trillion in real estate. And here's what I thought was a pull quote out of here. In 2022, annual HELOC originations rose 34% from the prior year to 1.4 million individual loans. That's the highest since 2008.
Since the time that you fell into that trap.
I was having those prayers. Now realize it, mine was like, because it takes a few years for this stuff to work through. So 2009, 2010 is about the time I had my blow up moment. So guys, just be careful, because all that access to cash, and you think you're being so smart and you're being a financial mutant. That's not. You've got to have cash in your account. And that's our goal today, is to tell you, okay, if you guys have convinced me cash is important, how do we maximize this? Because you've already told me checking accounts at your local bank, they're probably paying practically nothing. Your savings account at your local bank, they're taking your 17-year relationship for granted and paying you less than 0.5%, when there is such a better way that you can get tenfold that return on your cash.
And look, cash has been trashed for a long time. We have been begging for rates to get to where they are now. So now that they are at this point, you should take advantage of them. So let's go right into what you're talking about, Brian. Talk about the different types of cash accounts available to you. Now, a lot of people might not realize this, but there are a number of different vehicles that you can use for your cash savings. And the first of which, we're going to skip above checking accounts, right? We're going to assume you know that you need to have a special type of account to park it in. The first is just the high yield savings account. This is probably the most common, the easiest to set up, and probably the one that we're all the most familiar with.
Yeah, because this one is going to have, all the protections and everything. This is just a step above your savings account, but it can actually have a great return for your long-term self.
So let's talk about some of the metrics. Generally speaking, when you have a high yield savings account, you can set it up with a bank or a credit union. You can also make sure that your deposits at these institutions are insured either by the FDIC if you're with a bank, or through the NCUA, which is a credit union association. You want to make sure if you're holding money in a high yield savings account, it is secured by those insurance amounts to make sure that you stay protected. From a liquidity level, these assets are very, very liquid. You can get to them quickly and easily. A lot of times you can either access them directly or you can move them back and forth between your checking account as needed. They have a moderate adjustment speed when you think about how quickly the rates adjust. We'll talk more about that in a second. And they are remarkably easy to set up. A lot of these can be set up in as little as 10 or 15 minutes, either by going into your bank or by doing it online to get your account established.
Now, here's the first kind of nuance thing we'll talk about. You can, I'm sure your local bank, your brick and mortar is going to tell you they have a high yield savings account, but where we're going to focus our attention is a lot of these online banks. If you think about like the Allies, Marcus, and some of the others, you just go, because we'll cover in a minute, you can go to Bankrate. They'll usually every month rate the banks. But before you just choose the top of the list, hang in there because we have some tips about teaser rates and other things. But guys, you need to understand the reason we love online savings accounts is because they do give you a better rate of return.
That's right. They are a very attractive yielder, and they tend to move pretty well with interest rates. I mean, obviously, we've been in this rising rate environment over the last 2 years. Well, one of the things that we've seen is that the returns we're receiving on our cash has moved along with that. If you look at this illustration, this actually shows the rate adjustment speed from October of 21 all the way through July of 2023. And what you can see is the high yield savings account, and we're just using Ally as our proxy here. You can see what the rate it was paying back in 21 relative to the federal funds rate. And then as the federal funds rate has increased, you can see that it's done a pretty decent job of keeping up with the increases. So as rates get higher, you as the investor, you as the cash holder get paid more. A lot of time the brick and mortar institutions won't do that. They are going to be slower to pay you these higher rates. So you want to make sure that you are an active consumer seeking out accounts that will reward you for taking advantage of their services.
By the way, I want you guys out there to know that you are actually benefiting from my craziness. And what I mean by that is if you actually go try to pull historical rates at, between high yield savings accounts, money market mutual funds, it's hard to find it. You cannot find that information, but I am crazy enough that I have money in all these different places that Megan and I actually sat down and went through my own account statements to pull this up. And what I found interesting, Bo, now we're getting 5% on or close to it. I know, just yesterday, because we had a rate increase here in July, Ally has gone to 4.25%. Yep. But what people don't remember, because we have short attention spans, short memories, when the Fed funds rate was sitting very close to zero, the only place you could get yield really was like in these high yield savings accounts, and they were paying 0.5%. And we were
so happy about it.
Happy for the 0.5% because it was better than the 0.01 at your brokerage account, the 0 that your checking account was doing. This was something, but now that we have actually seen the funds rate go over 5%, this is the time to wake up, guys. Wake up and start maximizing what you can do.
So we have high yield savings accounts. There's another type of cash account that's kind of like a kissing cousin. It is very, very similar. And these are just called money market accounts. They're almost identical to high yield savings. The big difference is how you access the money. Oftentimes with a high yield savings account, you'll have to move money back and forth to your checking. With a money market account, you may actually have a checkbook associated with it or a debit card. And with money market accounts, they're more likely to have specific account minimums or limit the number of transfers you can do, or they might not have quite as competitive rates. Very, very similar though. So you should know, do I have a money market account or am I taking advantage of a high yield savings account?
The kissing cousin.
I thought, you know what? I knew it was going to get you. I knew that was going to get you.
But it is. I don't want to hang on this too much. But these are very similar. What I typically see is that they might restrict how much you can put money in or take it out. They might give you a little bit higher rate, but very similar to the high yield savings account. But I think it's important because I've been waiting for the opportunity to bring in, because we've talked about primarily FDIC protected. These are the accounts that banks offer, $250,000, but there is an alternative, money market mutual funds. They're not specifically as safe because they don't have the FDIC, but they have their own level of protections. But let's walk them through the difference between, because it can get confusing. The language sounds so similar.
sound
Money
alike.
market
Yeah.
accounts, money market mutual funds. Walk them through the compare and contrast on this.
Yeah, it's a little bit different. Money market mutual funds are exactly what they sound like. They are actual mutual funds that invest in cash or cash-like instruments. So where your money market account or your high yield savings account might exist at a bank or credit union, generally speaking, a money market mutual fund will have to be held inside of a brokerage account at a large brokerage institution. Brian, you already mentioned that money markets or high yield savings are either FDIC insured or NCUA insured. Money market mutual funds are actually covered under a different type of insurance, the SIPC insurance, which covers securities as opposed to cash accounts. It's a little bit different, so it's something to make sure you're aware of. From a liquidity standpoint, these are also very high liquidity, meaning if you put money into a money market mutual fund today, you can get that money out tomorrow. There are no penalties, no restrictions to doing that. And the rates adjust on these very, very quickly. It's one of the reasons right now we think that money market mutual funds are perhaps even a little more attractive than money market accounts or high yield savings accounts. And the ease to set up, we said it's moderate. It might not be quite as easy as opening a high yield savings account or opening an account with a bank you already have a relationship with, because generally speaking, you do have to have access to a brokerage account. You have to open a specific investment account, even though what you're planning on holding in there may be cash or cash instruments.
So the things I want to focus on, the two things is liquidity and then the rate adjustment. The first thing, liquidity, the thing you have to worry about with money market mutual funds is the whole break the buck.
Yep, that's
because whenever you've got a money market mutual fund, they hold the net asset value right at $1. There have been a few times in history, I think about 1994, and I think about Lehman Brothers in the 2008 collapse. There are moments where breaking the buck does become a risk. Now, the good news is, because I don't want to scare everybody and you're thinking that this is an access to cash problem. With the Fed funds rate being over 5%, the majority of these money market mutual funds now are Treasury bills.
Treasuries
So
repurchase agreements
that's why liquidity is high. But I want to make sure we give a full education on the way these work. But here's why this is valuable, and you kind of alluded to this, Bo. The rate adjustment is very high on this. And while we're in a high interest rate environment right now, or a fast moving interest rate environment, that can be very valuable.
Yeah, if you look at this, again, that we're showing this rates increasing from October of 21 all the way through July of 23, as we've been in this rising rate environment, you can see that money market mutual funds, and again, we're just using Fidelity Cash Reserves as our proxy here, has stayed very, very close to the federal funds increase. So every time the Fed comes out and raises rates, it's not uncommon for us as money market mutual fund holders to see, oh wow, the yield, the 7-day yield on my fund actually increased. So if you want to think about how these compare, you can look at how a high yield savings account like an Ally account compares to the federal funds rate and how that compares to a money market mutual fund. And as we've been in this rapidly rising rate environment, the money market mutual funds, in our opinion, have been some of the most attractive. Right now at Fidelity, you can go get yields at around 4.7, 4.8%, or for larger balances, if you carry over $100,000 of cash, you can actually get above 5% in yield right now in money market mutual funds, and they still have protections in place. It's not FDIC insurance, it's SIPC insurance. So you want to make sure you understand the differences there. But man, 5% on your cash is amazing.
Yeah, I think about let's talk about hassle factor and coordination here. Is that, as you can see, let's go back to 2020 and 2021. That's on the far left here. The best game in town was the high yield savings accounts because they were paying 0.5% like at Ally. But like I said, these are my different account statements. Fidelity was only paying 0.01%. Yep. I mean, it was
so better be an Ally at this
almost
point.
Nothing.
Yep.
So what I want to warn everybody of is that while we're in a rising interest rate environment, without a doubt, money market mutual funds are awesome. But I do foresee there will be a moment in the future whenever the Fed starts cutting rates again.
Yep.
You will see immediately all these money market mutual funds will also start cutting just as fast as the Fed does. There could get to a crossover point that as they're cutting rates, the high yield savings account will not adjust as fast, and it will likely, I'll just say likely, become once again the higher performing option.
Now, we're not suggesting that what you ought to do is like move money back and forth, back and forth, back and forth, snip, snap, snip, snap. That's not what you ought to be doing. However, you should recognize what kind of rate environment are we in. And so it might make sense that if you do have a high yield savings account, you don't close it down. Maybe you leave it open. Maybe you leave some small sum there, and you can actually link that to your brokerage account so that depending on where we are in the rate environment, you can just move money freely back and forth to take advantage of those high rates.
And you make a good point. Look, I don't want, like I said, hassle factor. If you're running a typical, say emergency reserves of $25,000 or something, then I don't think that the hassle factor means you should be chasing the hottest and highest rate, because we're talking about 4 to 4.25% versus 4.75 to 5%. So there's about a 75 basis point or 0.75% spread here. However, if you are a business owner and you're running payroll, I'm talking about big payroll and other things where we're talking about you keep cash in six-figure status. You better pay attention, because I mean that's the big part money. That if you are in charge or you run a large cash reserves, these 75 basis points can be thousands upon thousands of dollars. Don't waste the moment.
All right, Brian, let's talk about two other types of cash holdings. So we'd be remiss if we didn't mention these. This first is a little bit more of an old school solution, certificates of deposit. Most of us heard of these when we're growing up. You know, it's this thing where I can go put my money into a certificate of deposit and I'll get some sort of return on that. And there are generally two types. There are traditional CDs that are offered by banks or credit unions, and then there are brokered CDs that you can actually buy through an investment account. And they are either going to be covered under FDIC or NCUA, or potentially if it's a brokered CD, it might also be covered under SIPC. The liquidity level's not as high in these. When you put your money into CDs, you are kind of tying it up for a certain period of time. If you buy a 1-year CD or a 2-year CD or a 5-year CD, you're sort of making a commitment that you're not going to need the funds in that period of time. So CDs might not be a perfect solution for your emergency fund. In terms of rate adjustment speed, they generally adjust pretty quickly. However, you are locked in. So while new issues may be at higher rates, if you bought a CD today and then rates went up 6 months from now, your CD would not increase. It's just new CDs that you might buy. So that's why a lot of people look at trying to ladder CDs, but even that might not be the most wonderful solution right now.
Well, I think a lot of people, because you've heard the Fed is hopefully getting close to the top of where we're going with rates. So a lot of forward-thinking people are saying, well, you know what, I'll lock in, because I remember back in the early '80s where if you hear people joking about they locked in like a 10% CD for a period of time, but we're in an inverted yield curve period. So what that means is that interest rates are actually higher for short-term assets than they are for long-term assets. So you'll quickly see,
which is super uncommon.
Yeah, so that's not necessarily a great thing because it's a predictor of recessions and other things. It's a unique thing, but here's what I'll tell you. If you go out to 5 years, you'll quickly see that the CD rate is 4.5%, whereas the CD rate right now for a 1 year is like 5.25%, maybe even a little higher than that. So this is not something that you can go lock in and say, hey, my safe withdrawal rate is 5%, so why don't I go lock this in for the next 15 years? It doesn't work that way because of the inverted yield curve. They actually adjust the rates down the longer you go out. So just be aware of that. But it is something that if you know you don't need money and you want to get a little extra juice on the performance, it's not the worst thing. And by the way, they've also made it easier. A lot of brokerage accounts now allow you to create ladders very easily, so you don't have to do like my grandfather where he drove all over town,
every bank in town,
opening up teaser rates or CDs at all these different accounts. You can actually in a brokerage account buy, and because you're buying actual bank assets, they're FDIC insured, but with the additional SPIC protection just in case the brokerage company ever defaulted.
Yep. All right, so let's talk about the last one, Brian. Now this one, again, we're going to mention it because for a moment, this type of cash holding was the belle of the ball. It was super, super high headline stuff. And these are I bonds. It's these things that adjust with inflation to protect you in an inflationary environment. Again, whereas some of the other cash products we talked about are issued by banks or credit unions, these are actually issued by the U.S. government. And the safety is they're federally backed. They're backed by the full faith and credit of the U.S. government. So they are secure. However, they are not incredibly liquid. When you go to buy I bonds, you are making a time commitment that you're going to hold on to it sort of in two frames. The rate adjustment speed is based on inflation, so it's less tied to federal funds rate and more tied to the inflationary environment. And the difficulty of setup, we said moderate, that's being kind, because the only way that you can get these, you have to go open them up at the federal website, treasurydirect.gov. And I would say it's not my favorite website.
Well, it's also limited. I mean, these were limited to $10,000, and they had restrictions, 1 year to 5 years, on your access to it. And everybody, if you've played around with treasurydirect.gov, it's not the easiest website to navigate. Nope. So that's what the hassle factor on this wasn't worth it, because if you think about rates came to 5%. Everybody lost their mind when they were at over 9%
yep.
for a small moment in time. You have to ask yourself, was that $400 squeeze of the fruit to now have this additional account? Now, for a lot of people, the answer is yes. I mean, 9% is still legit, but you can see now it's below 5%. It's in the fours. So it was a moment in time, really.
So we're suggesting that you should hold cash somewhere. Now, where you choose depends on you. It depends on what your preferences are. It depends on how you use your cash. It depends on the benefits that you're looking for. But there are a plethora of options for you out there to get your money working for you. But we do want to say, as you think about this, what types of accounts to open, where you're going to hold your accounts, there are some pitfalls we want to make you aware of. The first, make sure that it is, if you're going to hold a savings account or a money market account, that it is insured, whether you have the FDIC, NCUA, or the SIPC insurance. And you can actually go to the websites and check that out. You don't have to just take their word for it. Make sure if you're going to use an online savings account that maybe you've never heard of before, you go to the FDIC's website to make sure that you see that bank listed there so you're not getting bait and switched.
Yeah, teaser rates. I mean, we've kind of, I want to make sure we keep this moving, but Bo, this is something you and I have had a lot of discussion about.
Yeah, because I did it wrong.
You go to bankrate.com and you will see some banks, at the top of the rate list, the yield list that you've never heard of. They might be playing the teaser rate game. And like Bo and I have talked about this a great deal in other cash shows, is that what will happen is you go open this account, you get that teaser rate, but you're going to notice over time they all of a sudden start dropping the rate significantly. I'll go ahead and say, because one and it's a big bank that I've actually dealt with, Capital One is notorious for this in some ways, because they come up with new products that they rebrand as a different money market mutual fund that you have to go open. I mean, a money market account that you have to go open up, or a high yield savings account. And if you're in the old one that used to be the top performer, you're just kind of left, and you have to physically call them or go online and transition to the higher. They don't just give you and take advantage. That they're an ungrateful service provider in that aspect. Be careful of the teaser rate, because it is a true game, because banks use this to harvest assets and then take you for granted and really mistreat you. Well, that's why I would tie into an institution that keeps you top of the game no matter what's going on with interest rates, so you don't get stuck.
Yeah, and don't forget to know, are there account minimums? Are there fees that I'm paying? Are there transfer limitations that I can have? You just want to go into it with eyes wide open so you know what you're getting. So in addition to making sure you're aware of these pitfalls, you also want to think about some of these other things. Do I want to have everything in one place, or am I okay having money at a bunch of different institutions? Do I want to walk into a brick and mortar to see a human being? Or am I completely okay with virtual? If I need access to cash, do I go to the ATM? Do I want a really good mobile app? Or maybe do I want a provider that allows me to do different savings buckets, where I know that this is my car fund, and this is my home improvement fund, and this is my fill in the blank fund? These are all things to consider when you figure out what kind of high yield savings account or high yield cash account might make sense for you.
Yeah, so go do your research, guys. This is an important time. Don't take it for granted. Go to bankrate.com, check out those different rates. I mean, this is the time also, guys. Don't get greedy. I want you to encourage you. Keep it simple. Make sure you are making a partner. Because remember, those relationships last 17 to 18 years. So measure twice, cut once, and do it right the first time. The biggest takeaway, guys, is you're going out to moneyguy.com/resources. Take advantage of all of our free stuff. Is we just want to make sure there's a better way to do money. I'm your host, Brian Preston. Money Guy team, out. So, Bo, the reason I did that, this was not a Q&A show. There's no way that's a Q&A show. Because, I mean, look, we did that as fast as we possibly could. We ought to tell the team just in case y'all want options. But we can get back to the.
So, team, consider this your notification that you now have options.
Well, this is also a great setup. Reeby's not here. So we needed somebody to come off out of the wings and help us out on kicking this off. And Bo, I couldn't help, as a proud papa, to say, this is the last week that we have an intern here for the Money Guy Show. Why not put them on the hot seat and let them ask us the very first question?
I love it. So if this is your first time hanging out with us, you know that we love putting together content. We love being able to answer your questions. So we have the team out there collecting your questions so that we can lean into the things that you care the most about. So with that, intern Avery, I am going to throw it to you to load us up.
All right, thank you. CB asks, my parents want to start putting my name on their bank accounts as they're getting older. I know this isn't the best decision. What should they do so I can manage their finances so they can't, if they can't?
Oh, wow. Okay, Brun. So I got to add, it's no coincidence here. She's saying I've got aging parents, and that is this like one of those I have a friend type deals? Is this what's going on?
I planted a question so that she could ask me, because this is what we're doing. We walk around and strap people to our accounts. But let me tell you guys, if you want to get us fired up, this is one of those things that I see people do as their parents start getting older. They just start putting their kids on accounts. They put them on the deeds of houses. They put them on their bank accounts. And I'm telling you, do not do this. Stop. Do not pass go, because here's the problem you might be creating for yourself and your family, your parents, your aging parents might be creating a gift tax trap. A lot of people don't realize, you're only allowed to give $17,000 a year without reporting it. Once you go beyond that $17,000 to an individual, you're supposed to be filing a gift tax return, Form 709. And now realize each person in the family, so if you have two spouses, they each get to do $17,000 to individuals. But this is something that I see a lot of people run afoul, and they don't realize they've done it, because it's not uncommon that you've had an older person that's been collecting Social Security, has savings. So these accounts might be $40,000, $50,000, $60,000, and they just go strap their child on there. You just created a gift tax problem. There's a better way. What I have found is banks have modernized, Bo. You can do payable on death. If you don't want to run through your estate documents, if you live in a state that has high probate costs, you can go to your bank and just add a payable on death. And if you want to have access, there's nothing wrong with seeing if your bank account can actually grant access to your account through like a power of attorney. You could do a revocable trust. A lot of states that do have probate issues, you can set up a revocable trust, and then you can set up your children or whoever's going to be helping you out with that part. There's so many options, but do not do what you think is the simple solution, but create great complication for your family.
Yeah, I tell you, one thing that really breaks my heart when I see this, not only like you run into the gift tax consequences, but one of the things that might happen when you start just adding children onto real estate deeds or onto investment accounts, you may be taking away one of the most valuable tax planning strategies that exist. Do you realize that when you pass away and when you leave assets to a child, that child gets what's called a step up in basis on those assets? That if you bought a house for $100,000 and now it's worth $150,000.
No, say $1 million, because there are people out in California bought houses for $60,000 to $100,000, now worth well over, maybe even $2 million. And if they did this, it would be a disaster.
That's right, because what happens is when you pass away, on the date of death, the basis, the amount that the government considered that was paid for that house, gets stepped up to fair market value. So again, in this situation, if your parents bought a $50,000 house that's now worth $1 million, and you inherit that $1 million house, all of that capital gain goes away. It essentially evaporates. Well, this is true for real estate purchases. It's also true for brokerage accounts. So if your parents think they're doing a good thing by putting you on their accounts, what they're actually doing is making a gift where their basis carries over to you instead of letting you inherit this. So one of the best ways you can protect against this is just simply education. Understanding, okay, Mom, Dad, what is it you're trying to accomplish? Okay, great. If you want me to be able to help you with your accounts and you want me to be able to help make decisions, I can have a power of attorney and I can help make you I can help do those sorts of things, but we don't necessarily want it to be in my name, because if it's in my name, there's a good chance we could lose some very real tax benefits when we do that.
Yeah, remember how I said when you're successful, complication will track you down, and that's when you might need to take the relationship to the next level. This is a perfect gateway because this stuff gets intricate. You also got wishes, you got unique relationships. It's nice to have kind of somebody in there to help you navigate those tougher decisions. So definitely consider fulfilling the abundance cycle. Take the relationship to the next level. This is the type of stuff that a good financial planner can help out with. Now, I would be remiss. I have absolutely loved having the intern here this summer, and and I'm not trying to embarrass her. But I will say, I knew that when she started working, because, at Chick-fil-A years ago and then other jobs, she's a hard worker because she still has employers trying to chase her down. It's been outstanding to have you here. I'm not trying to embarrass you, but I am a proud papa moment. And I just wanted to kind of celebrate your success this summer. I think the entire crew has enjoyed all the animations and other things that you've added to the show, so thank you. Now she's gonna be mad at me.
Awesome. All right, can I ask another question? Is that okay? Can I throw another one to you?
Okay, yeah, sure.
Is that all right? Here we go. This question is from Tim. All right, Tim says, "Hey, I know the FOO allows us to have a 3 to 5% down payment on our first house. But would it still be good just to save the 20% or more so that I can lower the payments later and increase my savings later?" Saying, I know you said that I can do 3 to 5, but should I only do 3 to 5, or should I really go for 20? If I can get to 20, should I do for 20? How do I go about making that decision on what is the most advantageous thing in my circumstance to make sure that I'm following the FOO the right way?
Yeah, now realize, and I couldn't remember because I was still in the proud papa moment, but it's Tim, was this for a first home? Because that 3 to 5% is only for the first home. And realize there is a difference, something that I maybe I don't highlight it enough. 3 to 5% is just to get you in the door of home ownership, but there is a downside to it. And I see this in the comment section is PMI. A lot of times, if banks, when they're going through the whole mortgage process, if you don't own 20% of your home's value, they will start charging a PMI. It's an insurance to protect the finance company from you defaulting on it. And a lot of people are very quickly, if you do 3 to 5%, you're hoping your house either appreciates or you pay it down over the years so that you can get rid of PMI. Because now back in the day, old school moment here, PMI was not deductible. At least now it is deductible. But I still stand by the fact, Tim, that, I give you, it really depends upon where you are in the financial order of operations in the process. Because I've also seen people who had a windfall of money come their way, and then they were young and went and put down big chunks of money on a house, even beyond 20%, but then didn't have their emergency reserves, weren't funding their Roth IRAs, weren't doing all the things. So just you need to have more of a full, complete picture. That's why I love the financial order of operations, is it lets you walk through the way you should look at money. So, Tim, I would, if you have the money and because of your success and you have already funded Roth and stuff, I like 20%.
Sure.
But it all depends upon what else you've got going on in the background. 3 to 5% is supposed to be a gateway access point, because I know homeownership is so hard these days.
I agree with everything that you said there. The only thing that I would add to it, that I would encourage Tim to think about, if you've not downloaded our wealth multiplier, Brian, you have a wealth.
Yeah, I got that over here too.
If you go to moneyguide.com/resource, we have a wealth multiplier that shows you how powerful every dollar you have can be. It's the reason why you have these koozies that say this $1 beer cost me $88, because we know what our money can turn into, especially when we're young, especially when we have a lot of time. The decision behind putting down 3 to 5% versus putting down 20%, I think, once you've solved for the rest, I'm following the FOO, and I know that whichever one is going to keep my mortgage payment, my housing cost less than 25%, it becomes an opportunity cost discussion, right? And you have to make the assessment for you. where do I think, if optimization is my goal, because again, we have to let our goals drive the decisions that we make. If optimization is my goal, where do I think that my dollars can be optimally used? And so it depends on like mortgage rates right now. If I can go get a 6% mortgage rate, if I put an extra 17% down, extra 15% down on the house, I'm gonna save that interest, I'm gonna save that mortgage rate. Or if I had those dollars that I could go deploy, might those dollars be able to work harder for me somewhere else? Now, I hate giving you this answer, but it's a spreadsheet calculation and you have to make the assessment. You have to assign your specific variables to figure out if you've done all the other things and you're following the food and you've checked all the boxes, when it comes to your situation, what's the most optimum decision for me? And I think I would let that drive a lot of my decision-making process.
Yeah, it's no different if you're in that moment of abundance, meaning you've got a lot of, money's coming in, good job, you have assets in the bank. This is no different when like we tell you 23.8 for buying a car is so that you have reliable transportation. But if you are living this abundant life, still paying cash for a car is the ideal. No different than when you buy a house if you're living in abundance, especially with interest rates being over 6%. 20% is the ideal because it avoids a lot of the hassle with the banks, the underwriting, and the PMI. But we try to create a system that allows reality to kind of sit inside there too. Because there's a lot of, as the system gets harder, as the process of society and access to cash and other things, you've got to have things that allow you to move within the system. And that's what we've tried to create.
Love it. Tim, thank you so much for that question. All right, Brian, here's a question. This one is from Robinette. I think I pronounced that right. She says, inflation has been cooling to just 3%. So, we came through a high inflationary environment. It's come down some, according to the latest data. But the Fed is expected to continue raising interest rates. So let's see if I want to know if you agree with that. So with that, and with student loan payments about to restart here in the next couple months, could that throw the economy into a recession? Is that something, I'm ad-libbing now, is that something I should be worried about? Is that something I should be concerned about? That, man, there are some recessionary indicators. How should I navigate that when it comes to my financial life?
Yeah, we've done a show, and I loved how we did it, is that please don't let Fox News or CNN be your investment advisor. It's because whenever we let the news media, your politics, or any of those, or even you trying to pontificate yourself, lead your investment decisions, you might be surprised to find out that you're wrong. It happens all the time. I mean, I've shared where we've had clients who've sold out of things because of volatility, who've sold out of things because of politics. And then, but I always say, guys, clear the air. Here's the reality of the situation. Always be buying.
ABB, baby.
Because the reason ABB works is that it doesn't allow your behavior, it doesn't allow your blind spots and other biases to, or things you just can't think about. You might be wrong and you're going to miss out, because not only do you have to get it right on the prediction you're making, but you have to get it right on when you get back in. And when you're dealing with a system, the law of accelerating returns, and then knowing historically 8 out of 10 years markets are going up and making money because humans innovate. We grow, we expand. Instead of trying to beat the market, just be the market. That's why we talk about index investing, and we even make that easier by talking about target index retirement funds. So you just choose how much you can save, when do you need it, because then that the rest of that gets answered by the diversification of how much is safe assets versus how much is aggressive trying to grow. You do not need to be worried about all this stuff, Robinette, because I think you're going to stress yourself out. You're going to miss opportunities. You're going to waste calories on something you can't even control. Really, the biggest thing you can control is where are you in your financial order of operations? When do you need access to cash? Build your plan around the goals, around you as an individual, and maximize the moment.
Whenever I get nervous about something, there's an exercise that I like to walk through, and this is not original to me. I heard it from somebody, and I just stole it. And benchmark it. It's the 7 so whats, right? Like, so you start asking this question, okay, what do I think if the recession is going to happen? Okay, so what? What does that mean? And then what? And then what? And then what? And by the time you get to the 7th so what, if things aren't so bad that you're destitute and living on the street and can't eat and that sort of stuff, then odds are it's going to be okay. So what's the worst case scenario if we were going to head into a recession and you invested dollars today? Well, we've done plenty of shows on Bob, the worst investor ever. Like, what if my timing is just so bad that all I ever do is I put my money to work at the absolute market tops? Well, if you did that for the last 5, 10, 15, 20, 25 years, you have still likely become famously wealthy because over time, the market has tended to go up and the timing did not matter near as much as the time in. So Robinette, just you showing up and putting your money to work is awesome. And if you have a long time period until you get to retirement, until you get to financial independence, you shouldn't really care if there's a recession coming. Save, you should actually be excited. You should be a financial mutant that says, holy cow, I'm not saying you should pull for a recession. Don't pull this out and quote me on that. But you should be thinking, man, if the market goes down and I see some opportunities, I'm going to figure out the ways I can squeeze. I'm going to get a few more dollars. I'm going to max out my Roth IRA. I'm going to go max out my employer-sponsored plan. Because those dollars that you can save in the down years, those dollars that you can save through the volatility, are often some of the most valuable dollars you will save in your entire army of dollar bills. If you don't believe me, go look at contributions that were happening in fourth quarter of 2018. Go look at contributions that happened during COVID. Go look at contributions that happened during 2022. And when you see what they've done now, you're going to be like, holy cow, there's something to this investing thing.
Well, I'll give you some actual stats. I was doing some charitable giving out of my joint account last night. And Bo, I was like, because when I first looked at the account, I was like, okay, I'm going to give this account, I'm going to give this fund, because I have one of the technology funds, index fund. It was one of the Qs. I don't mind sharing that. And I couldn't give it away because I hadn't held it for 12 months. And it was up over 40%.
It's amazing.
That means I have held this since September of 2022. And we haven't had it 12 months, so I can't give it away. But it is up over 40%. It talks to exactly to the point. And that's what I'm saying, guys. Don't be a market timer. Just get your time in, because over the long term, it turns all that volatility. It's amazing. We've even done illustrations where if you tried to scatter plot the volatility of each year of an investor, it looks like you literally are throwing darts. But if you go on a 10-year, 15-year, and actually look at performance when you get to a long-term spectrum, it starts turning into a wave, a pattern to it that is a very tight pattern. It's not like it's even volatile like an EKG. It's a very tight pattern that goes around historic norms. Guys, just be careful with the timing. Don't let the news media scare you. Don't let your peers scare you. Let your goals, let your plan, let the financial order of operations system be the guiding beacon that gets you to your goals and the best version of your financial self, because there is a better way to do money.
Robinette, that was a fantastic question. Thank you so much. All right, this next question, Brian, this is from Andre. Andre said, where in the FOO does rental property investment land? If I want to buy a rental property, not necessarily a REIT, but become a landlord, like I have a desire to do that, where do I start saving for the down payment? And how do I know that I'm ready for that? And Brian, I think this question's so good because I feel like if you go watch TikTok or Instagram or fill in the blank, this is the only way you become wealthy. You got to go become a real estate landlord, and you got to figure out how to figure out the real estate game. What do you think? Where does it fit in the FOO?
I love this question because, by the way, we get a bad rap. We love real estate. We even do real estate. I mean, I'm talking about we are 8-figure real estate type people. That way, for all the folks out there who say these guys don't know anything about real estate. But here's the thing I would share is that, and this, I want to give some clarifications. A lot of you who there is an easy way into real estate if you have the opportunity and your kids can go to the school in the areas. House hacking is a legit thing. We've seen so many people, because basically a house hack means that you are renting out part of your primary residence. So if you bought a duplex, a triplex, a quadplex, but you are living in that building, you actually just bought a primary residence that you get to rent out. If you can financially do that, that's not what I think Andre's asking about. Andre's asking about somebody who's not house hacking with their primary residence. He's actually thinking about buying rental real estate.
A wealth building tool.
So where does that fit in? Because all over social media, they make it seem like it's so easy. And the thing I have found is that I don't see much true passive rental real estate, because we have tenants who, I've heard me tell my stories about the tenants changing engines in the living room. People who, when they get ticked off, they leave, they rip out the cabinets, and yes, you have a security deposit, but you'll quickly figure out, you hope they just destroy the sheetrock, because you can replace sheetrock and carpet pretty easily. When they start ripping out fixtures and cabinets, it gets very expensive. But I still think that, especially if you know where the real estate market is from a valuation standpoint. But I will tell you to be a little nervous, because we've seen, like I was looking down in Florida for myself, and most of the property in Florida had appreciated by over 50% just in the last 3 years. So I start thinking about the cyclical nature of real estate. Do I think I'm going to make a lot more money on this Florida property now, or are we going to probably be sitting flat to let the historical returns kind of catch up, reversion to the mean? If you're catching that, the purchase price means a lot. So that's something to consider. But from a cash flow, and that's really where the question is. I'm giving you way too much nuance, but I want you to be educated. It is a step 8 of the financial order of operations. If you go to moneyguy.com/resources, you can download your own version. The reason I say it's a step 8, prepaid future expenses, or as I affectionately like to call, abundance goals. This is when you have enough financial foundation underneath you. You've got your employer match. You've paid off all the high interest debt. You've actually got cash reserves. You've taken advantage of the Roth opportunities to get some tax-free growth, your employer's retirement matching, and maxing out the retirement. But this is where you get to step 8, where you say, okay, I got enough jingle in my pocket to make it through whatever ups and downs. Because when we bought our first big commercial real estate property, there's our landlord at the time, who owned a lot of downtown Franklin. He said, boys, I'm proud of you. Just make sure you got enough money to make it through the next rough patch. Because it happens. I mean, it is going to happen. And that's why, just promise me, if you're going to go into this fun world of real estate where you get to take advantage of leveraged real estate and the return of what leverage creates for you, you got to have the pockets to make it through the long, slow winters where people don't pay rent, and yet the banks still want their money. Yeah,
Brian, you do a great job. You always tell people, if you're going to start a business or you're going to start something like real estate, you ought to put on your 3D glasses. You have these 3 plans: this dream plan, this down-to-earth plan, and then what you like to call the doo-doo plan, right? I think a lot of people don't really think about that worst-case scenario plan, but I would tell you, Andre, when it comes to real estate, I would ask you this question: what will it cost you if it goes completely wrong? You buy a limb. If you ever, what was the Tom Hanks movie, The Money Pit? Go watch The Money Pit. Let's assume that is your rental property, and let's go assume that you buy The Money Pit at the end of 2007. So, like, let's combine a bunch of factors that makes it really, really bad. Will it break you? And if you're in a situation where making that decision will likely break you and stop your financial journey, I would argue that perhaps you are potentially too early to the game. Or maybe you're a young person that says, hey, I'm already broke as a joke. I don't have anything going anyway, so it can't break me. I would argue that the amount of time and energy and calories and dollars that endeavor would take away from you, and if it might take 3, 4, 5, 7, 10 years to manifest, think about how much opportunity cost was lost by you not having your dollars working for you, building a solid foundation on I'm going to say lower risk, on a lower headache, lower brain damage way, just by buying low-cost index funds, following the financial order of operations. So if this decision could break you, could literally stop you in your tracks and halt your financial journey, I would argue that perhaps you're not at the place where getting into real estate might make sense. Now, if you say, okay, if I did this, it might slow me down, it might move me in a direction I didn't necessarily want to be moving, but I can still recover from this and I'm still going to be able to build towards all of my other goals, then I think that's probably a good indicator that maybe you are ready for it, assuming that you're in step 8 and you've done the things you're supposed to be doing.
Andre, as you get into this, one last word. Make sure you do your due diligence, background checks on tenants, because we saw in the last, in the pandemic, the government did something I've never seen before, is that they basically allowed you not to be able to very noble, not to anybody to leave the residence. But I got to tell you, for all you investors out there, be careful.
It's scary.
Because that's something that we're not the first ones to come up with that idea. If you go to Paris and other places in Europe, but that's why you see a lot of places that will sit vacant for years, is because the vetting, the due diligence to let people rent from you has gotten to be so hard. So just think about that. That's part of the doo-doo plan, is that what happens when I have the bank notes due, the mortgage payments have to be made, and nobody can, and I can't push out the person that won't pay rent. That's a legit thing, and that's not getting into the moral part of being a landlord and so forth. I'm just telling you, this is part of the numbers, the nuts and bolts of making sure you can afford in any scenario.
That's a great question. Thank you so much for that. All right, Brian, here's the next question. This is from Kyle. Kyle says, I'm about to turn 30. Do you think it's worth buying term or whole life insurance? Or do I not need life insurance at this time at all? So there's two questions here, Brian. When does it make sense to buy insurance? Do I need life insurance? Who needs life insurance? And then the second question is, okay, I need to buy it. What kind do I buy? Do I go get term? Or, again, I find all this fantastic information on Instagram, TikTok, Snapchat, all of those. I should probably get some whole life because I hear that's the way to really build wealth.
Yeah, I mean, this is a very individualized question, but I can tell you for most people, I'm going to talk in most people terms, Kyle. Your situation might be a little different. We'll give you some indicators of that. But for a lot of people, you're just trying to ensure a need that you have. If you passed away tomorrow, is there somebody that would be left in a really bad situation? So if you have a spouse, if you have children, that could be pretty catastrophic. But even if you have a great career trajectory and a lot of opportunity in the future, that's even worse, because you're in a situation where you leaving the planet early really is catastrophic. So if that's the case, when this is something you're saving diligently in the background, and that concern or that risk is going to go away in 20, 25 years as you're building your path to financial independence, that's perfect for term insurance. And that's what the majority of people, I think about every one of my own personal situation. Every time I had my daughter born, one of my daughters born, I bought more life insurance. And then as I had different life events happen, I added another. I essentially created my own laddered term life insurance situation, so that it timed out to when, as kids left the house, fully educated, hopefully that would no longer need it, as my financial independence for my wife, from needing money for the household would be taken care of. It's going to fall off at its appropriate time. That is all indicators of term. Whole life or permanent insurance, because there are many versions, there's actually several versions of permanent insurance. I have actually recommended that for clients. I had clients who had big estate planning issues. They needed protection immediately, because if they had passed away, and all their illiquid assets like real estate, eight-figure real estate purchase, assets that they couldn't sell quickly that were very valuable, they needed something almost instantly. That made sense for something more permanent. If you have health concerns, maybe you have underwriting, you're very healthy now, but there's a lot of family history and other things, that type of stuff might come into play. But don't get sold something. I want you to actually go through the process of doing the due diligence on what are the needs, what is your personal situation, and then making sure that intersects with everything that you're trying to implement. Because if you do everything based upon what's being sold to you, the fear, that's probably not going to work out well.
Yeah, I think a lot of financial mutants, we think through, if you think about financial planning as a pyramid, the very bottom of the pyramid is risk management. It's what we're all kind of taught at the beginning. And so some of us feel guilt if we don't go get insurance. Hey, I'm 30 years old. I'm not fresh out of college. Maybe I need to do this. I think it's okay to not buy insurance until you need it. Because realistically, yeah, it gets more expensive every year, but it's marginal. I mean, insurance, it's still pretty stinking cheap all the way up into your 40s. Like, life insurance is not an incredibly expensive thing to get for folks that are still young. And Brian, I'm gonna say still young is 50 and below. You know what I mean? Certainly 40 and below.
I would actually say it's 60 and below.
Okay, fair enough.
It's amazing how the older you get, the younger everybody seems.
That's exactly right. I don't mind sharing. The very first, when I started my career, didn't have life insurance. When I got married, did not have life insurance. I was working, she was working. If I got hit by a bus, she's gonna be okay. She's gonna marry again really, really quick. when I convinced her, hey, you ought to move to another state where you know nobody so that we can do this crazy thing and see if this thing works. And she did it, and then we bought a house, we had a mortgage. I said, oof, okay, now maybe I need to buy some insurance. It's okay to wait until it makes sense for you to do that. Same thing as you get older, as you get into financial independence, as you start having buckets of money sitting around that you're able to live off of, you might one day arrive at the conclusion, I have life insurance, but I don't really need it anymore. I'm at the point where if I were to pass away, my spouse is taken care of, my kids are taken care of, all the debt's taken care of. If you're at that place, it's still okay to not have life insurance. Our view is term insurance for life insurance in general should only likely be for a term. And you get to determine when that term starts and when that term stops. And if you're outside of those terms, I think it's okay. I don't think it's something everyone absolutely has to have. Kyle, thank you so much for that question. Okay, Brian, here's one. This is a good one that we can be unbiased on. Ethan says, hey, what are some signs that you need a financial advisor? Is there a difference between a financial planner and a financial advisor? Let me just start this one off for a moment. I'm going to answer the second part. One of the things that I think is by the way, for those of you who are just now listening to us for the first time, we are financial advisors. So let me go and put that out there.
And financial planners.
And financial planners. The problem with our industry is that really anybody can call themselves anything, right? Somebody can call themselves a financial coach, a financial advisor, a financial planner, a financial consultant, a financial intermediary. Fill in the blanks. So I think just operating by title alone won't give you enough information. What you really need to do is understand what that person does. Are they someone who only sells certain types of products? Are they someone who actually does financial planning? Are they someone who only focuses on retirement plans? Are they someone who just does taxes? You need to understand, okay, what does the person do and what is the thing that I'm looking for? And so that goes right into Ethan's question. What are some of the signs that I might be at the place where I need to speak with someone about helping with my finances?
Yeah, I love this question. I actually did an episode. It's crazy to give a shout out to another show to push people away, but did a ride along with George Camel.
Yeah.
And he brought up another, Ramit has the Netflix series and I've read Ramit's book and there's a lot of great stuff in there, but he with a passion hates financial advisors. So I think George, I think I got him because I think he was going to give me a gotcha question, but I told him, look, I think in a lot of ways I agree with Ramit on the fact that when people are in the beginning of their journey, you can learn so much. We live in a great new world where you can educate yourself, you can figure out a lot. But I do want to caution you. I think there is a graduation point. And this is when the question that Ethan asks is, when do you hire a financial advisor? Here's an experience share, and you'll see where this all folds in. I thought when I was, I wrote a book, and then I was going to self-publish. And then I had enough people whisper in my ear and go, man, with your platform, you really ought to give this thing the opportunity to be in public libraries, bookstores, because that's the legacy stuff that I think you're trying to do with this book thing. So I was like, okay, I'll go traditional publishing then, because the opportunity was presented. And I was like, but I'll self-represent myself, because I'm a do-it-yourself type of guy. And I got my first, it was actually too easy that I got the first offer from a publisher. And I felt really bad about this later, is because I found myself Googling all the terms and I realized, oh my gosh, I am way outside of my knowledge of what even these terms mean.
Not a good sign.
And so I was like, wait a minute, Brian, what are you doing? Here you are, you're a financial advisor, a financial planner. You help people because you've gone through hundreds of retirements for clients, unfortunately, tons of passing away of relatives, of helping people with all kind of unique things. But yet here you are in your publishing, you've only done one, but there are people who've done hundreds of these as well. I had an aha moment and I hired a literary agent. It was the best decision I made.
Great.
I mean, I tell every email, he probably is like, is this guy really this cheesy? Because every email I'm like, Brian, I hope you know how much I appreciate you in this journey. Because I went the other path. I did it I tried to start the process myself, and I quickly realized, so now I'm so appreciative. And that's why we used to have a saying, we haven't talked about it in a long time, Bo, is that Our best client is a client with a broken heart from a bad previous advisor or a bad situation from a do-it-yourself situation, from a moment, is because here's where I get to the crux of what Ethan's asking. When you are creating success, you will reach a point that you're like, man, I am out over my skis on this. Is that the risk of the failure or the risk of making a mistake is going to exceed the value of what you're doing, because you are the CEO of a 7-figure enterprise, or soon to be 7-figure enterprise likely, and you're going to be trying to figure out, can I retire? How do I get the kids' education? How do I do my estate structure in a right way so that I'm not band-aiding this in the wrong way? How do I do Roth conversion strategies? All these things are going to happen. And then you're going to say, I think I need somebody. And for really, literally pennies on the dollar, you can hire a CFO to come in who's done hundreds of these situations. That's the moment, Ethan. So I'm not telling you, I want you to come learn, apply, and grow for free. That's the abundance cycle. Come take as much as you want. We'll continue to feed you and give you the information and educate you on how all this works financially. But there will be a point that you will graduate to the next level because of the complication of the moment. And that's why I love giving experience shares, is because it's just, all of us do-it-yourselfers, all of us that are good with money, sometimes that can be a fault, that we're so good with money that we don't know when to ask for help. And that's why I love what we get to do for a living. That's why I sleep well at night, because I not only get to educate, but we also get to help people maximize their opportunities.
Ethan, I think there's 2 things I'll just add to that, because I agree with all that fully. There are really 3 times that we think you might, or 3 signs that you might want to hire a financial advisor. The first is the gravity of your decisions is so great, you feel uncomfortable going at it alone. 10% on $10,000 is not the same as a 10% on $1 million, right? So the scope and the gravity of the decisions becomes pretty heavy. The second is exactly what you said. Your life gets complicated. You don't know all the things that you don't know. Things just come at you, and you don't know how to navigate that. And the third one, and I think a lot of people see this, is life just gets busy. As it gets complicated, it also gets more busy, and we get pulled in 1,000 different directions with 1,000 different things going on. And it's very easy for financial matters like updating my savings amount, or updating my beneficiaries, or making sure that I'm properly insured, or reviewing my tax return, or all these different things kind of fall by the wayside. And you just check the box and check the box and check the box. Well, what a great financial advisor can do is keep those things in front of you. So if you find yourself in one of those 3 areas, or maybe you're at all 3, it might be a pretty good indicator. So let me give you something that'll help you. If you go out to our website, go to moneyguy.com/resources, we have 8 questions you can go ask a financial advisor. So if you're thinking about hiring someone, or maybe you're working with someone and you want to kind of figure out where they are, ask them these questions, and they should be able to give you very well thought out, detailed questions that you feel comfortable with, that makes you feel great about working with them. So if you are thinking about hiring someone, pull these questions out, ask them, and make sure you like the responses that they're giving you. Fantastic question, Ethan, and I love that you are thinking through that. All right, Brian, this next question, this is from Kevin. Kevin says, what housing financial advice would you have for somebody whose job can move them to a new city year after year? We have a ton of clients that fall into this camp. I'm 28, I'm married, and I have a 1-year-old. Now I know why I picked this question. And I'm a professional athlete in the minor leagues. Oh, that's so awesome. Oh, that's so cool. So his question is, I have a job where at any given moment I could change where I need to be living. I could have to move from one place to another place. So how do I go about thinking about housing? How do I approach that in a financial mutant way?
Well, I'll set it up, but I'd love you to kind of start this off, because you kind of resemble some of these things and know people who resemble some of these things. But Kevin, first of all, go to moneyguy.com/resources. We actually have guides as well as checklists on housing purchases. And I think that could be a tremendous value for you to go download that free resource. But Bo, you kind of you know people, or you've resembled some of these things,
Sure.
and he's not in his 30s, but this is starting to sound very much like a messy middle situation.
It's super, because here you are. You're like, okay, I'm married and I have a child, and so I'm in this place where I want to set roots, but because of my vocation, I'm unable to set roots. Now, I'm going to go on a limb here. I'm going to say it's okay if you don't buy a house, because when you go to moneyguy.com/resources and you download our house buying checklist, one of the very first things you're going to see is that when it comes time to buy a house, can you answer this question? Yes, I believe I'm going to be here for at least 5 to 7 years. If your answer to that question is not yes, I would argue that home ownership might not make sense for you where you are in your current state, because what you don't want to do is get in a position where, let's assume that the real estate prices have gone up really high right now and it's expensive. And so you try to buy a house, and maybe you're playing for a team or you're playing in a city that's a really high cost of living. And so you buy that, and then you get traded, or you have to move somewhere else, or you get relocated, or you get called up, or whatever the thing is. And then you have to move to a different area. Well, now you've either got to turn that expensive house into rental property, or you have to sell it. Well, what if something like 2020 happens? What if we go through a COVID? What if we go through a 2008 Great Recession, and all of a sudden you can't sell that piece of real estate? Now you are captivated. You are held there. So I think for someone in your situation, I think it's okay to be a renter. A lot of people operate under the assumption that when I'm renting, I'm just throwing money away. I think that is a false premise. And you mentioned Ramit earlier today. Ramit talks about this all the time. Renting is not throwing money away. It is buying flexibility. It is buying freedom, because all you're committing to when you have a rental is for the term of that rental engagement. So I'm going to be here for a year. I'm going to be here for a year. I'm going to be for a year, whatever that thing may be, so that at the end of that term, you know you can move and you can leave. There is no problem with doing that. Now, this is what I would encourage you to think about, because my wife and I had to navigate the same thing when we changed locations. We sold our house in Georgia. We knew that we were not going to buy immediately in Tennessee because we want to kind of figure out the lay of the land, and we had a few options. We could rent like the nice place, like the tippity top, super fancy, swanky apartments, or we could go to something that was nice and decent. And I told her, I was like, yeah, I love that they have all the amenities and all the creature comforts, but instead of us like experiencing that and getting to do that for a year, why don't we spend a little bit less on rent, something that still makes sense for us, and let's save that additional so that when we buy the house, then we can buy the things that we actually care about. Then we can focus on that. So I would argue one of the things you can do while you're in this like very mobile stage of life is consider doing very reasonable housing so that you can stack up as much money as possible, so that when you do know that you have roots somewhere, you have a base of assets you'll be able to use to make that down payment, to capitalize on that opportunity. You agree with all that?
No, I think that's great. And I love that you even gave the additional clarification, like on when you relocated up to Tennessee. Your place was nice, by the way.
Yeah, it was great.
But it's just that I feel like so many things now promote a lifestyle, like, you know, with the gyms, the classes, the Peloton classes, the access. And you have to just ask yourself, are you actually going to use
That's right.
that country club atmosphere at that apartment complex, or do you just need a nice place to live? And it just be a good financial mutant with your decision making. And then Kevin, you know, also when we get the big contract,
I'm about to say, when you sign the big one.
Hey, don't forget the abundance cycle. We'll be waiting for you.
I love it. Awesome. Kevin, thank you so much. Thank you so much for the question, and best of luck. That's awesome. All right, Brian, this next question is from Christian. I think a lot of people are in this situation. Christian says, for those who don't have access to employer-sponsored accounts like 401ks or pensions or those sort of things, what are some good ways to replicate those kinds of accounts and their benefits? I'd love for you to answer this question 2 ways. Number one, can I, on my own, replicate the benefits of a 401k? If so, how? And 2, if I don't have access, are there other vehicles I could use to think about wealth building and saving for the future?
Yeah, I mean, there's a reason when we go to financial order of operations, you know, it's just on repeat because this thing is that strong of a system. Go to moneyguy.com/resources, or if you want to really accelerate your success, you can go to learn.moneyguy.com. We have a deep dive course, but you'll notice step 5. After you've taken advantage of getting your deductibles covered, you're free of money from your employer, which you said don't have, so you can skip right past 2 to go to 3. Make sure you have a high interest debt, Then you got your emergency reserves of 4. That's at typically 3 to 6 months. Look where we land. This is where we kind of get to the launch point of starting to build your army of dollars. Roth and HSA. You can start right there with tax-free growth opportunities. I met somebody last night. We were out at a restaurant, and you always hear, he's like, "You're on YouTube, aren't you?" And I was like, "Yeah." And he's like, "Man, last year I opened my Roth IRA." And I was like, "Oh, that's awesome." Because that is a great place to start. But I want to lean into what Christian was just talking about a little bit more with, if you don't have an employer plan, if you're a W-2, you can always, assuming you make under the income thresholds, which I would think you would probably likely, do the Roth IRAs. And then I think a lot of people, if you don't have access, if you're not self-employed or you're 1099 and you can't do like solo 401ks and other things like that, I think a lot of people don't realize brokerage accounts, after-tax savings, can actually be great retirement tools because what they allow is they still have great tax treatment because you've got, dividends are taxed at lower rates, capital gains. If your income's low enough, they even have 0% capital gains. But what I like is they give maximum flexibility. So if you need to pull money out, yes, you might have to pay taxes on any gains that you have, but you have maximum opportunity to get access to that money for bridge, any type of big purchases or anything else that could come your way. So don't think just because you don't have a 401k that doesn't mean you just can't save in a long-term way to take advantage of index funds and growth opportunities. You too can save. It's structured a little differently.
The only thing that I would add to that is we're assuming that you might be in a lower income situation. When we say lower income, all we're saying is that your marginal tax rate on the federal and state side is less than 25%. By all means, focus on the Roth IRA tax-free wealth building. However, if you're someone who doesn't have access to a 401k, this often gets overlooked. You can do a deductible traditional IRA. So if you're someone who is in a higher tax bracket where that tax benefit may make sense for you, perhaps you could do a traditional IRA and you could take the tax deduction. That's a way to slightly replicate a smaller benefit that you would get in the 401k. And then maybe you're still able to do an HSA to max out some sort of tax-free growth and then move on to exactly what Brian said. The after-tax brokerage account is a great place to begin building wealth. I don't think that you'll be upset if you move in that direction. The key point is the behavior. The key point is to be saving. Don't be someone who says, "Oh, well, my employer to have a 401k, guess I'm just not going to save. Guess I'm just, if they had a 401k, I'd save, but since they don't, I'm just going to start, balling out." That's not what you want to do. Make sure that even if all you're doing is saving an after-tax account, you're still doing it, and your future self will likely thank you for that.
Yeah, I mean, the 20-25% is what our guidance on saving for the future of your income. You fill up the Roth IRA and then try whatever you need to beyond that, try to fill it up into an after-tax brokerage account.
Love it. Christian, that was a great question. Thank you so much for that. All right, Brian, this next question is from Jacob. Oh, man, I love this question. All right, you ready for this one?
Uh-oh.
Is it wrong that I don't want to be an entrepreneur? I'm told with saving I could retire well, but I'll struggle to be financially free between 40 to 60. Can I invest less for retirement and some for earlier? I don't understand the second part of his question, but I think this is what he's saying. I've heard that in order to be wealthy, if I want to be wealthy and I want to be able to retire early, I got to be an entrepreneur. And I even saw some folks saying that, wealthy people, they got like 7 streams of income. Well, I'm just a guy. I got a job, I check in, I get my W-2. Is wealth not something I'm going to have until I'm old and gray? Is that the way that this thing works? What would you tell Jacob?
Well, by the way, I love that stat that people give about 7, streams of income. It doesn't start. You gotta have 1 before you get to 7.
That's right.
Because everybody has their launch point to reach escape velocity into crossing into millionaire status. And from our own research, we interviewed. We actually sent a survey out to all of our millionaire clients. It was high 60s. I even think it was around 69%. Attribute saving and investing as their launch point moment that they reached escape velocity, what led to, and remember, Ramsey Solutions has that research out there that 80% of millionaires' first account to cross 7 figures was their 401ks or their employer retirement plan, typically around age 49 years of age. So I don't, so that's the actual what the norm is. It's not, it's not screamed from the rooftops, because I think it's just not the sexy sizzle that sells. Is that most people are just savers and investors. So I think that there's nothing wrong with that, Jacob. And Bo, I want to kind of send it back over to you, because I think one of the things I've always loved about you is that you and I met many, many years ago. You came into my business, and you've always been an entrepreneur.
That's right.
And the fact that you've kind of made my business into our business.
Yep.
And I think that is a tremendous opportunity for a lot of people out there in the workforce to figure out how you make your mark.
Yeah, I think what's amazing is we're sold this idea of, entrepreneurship, it's amazing, it's wonderful. And don't get me wrong, it is. It's a wonderful thing, but it's hard. There's a lot of risk associated with it, and there's a lot of things that come with the buck stopping at you. And so what I tell young people all the time is, hey, if you are enterprising, you don't have to go come up with a brand new idea. You don't have to come up with the thing that no one else has done or no one else has created. There is nothing wrong with coming into something good or something really good and putting your mark on it to try to make it great. That's exactly what you're talking about. It's an intrapreneurship opportunity where if I go to my job every day, and maybe I work for an organization that has 100 people or 1,000 people, but I treat that job as though I were an owner, I were a stakeholder in it, it's amazing how often that sort of thing can lead to financial success. When I add so much value to an organization that I cannot be ignored, it's amazing that you stop being ignored in those situations. But maybe that's not you. Maybe that's not even what your question is, Jacob. Maybe you're saying, hey, I don't want to do any of that stuff. I just want to do my job, do it well, go home, hang out with my family. That's awesome too. It does not require starting a business or inventing something or having some huge cataclysmic event to be wealthy. What it requires are the three ingredients of wealth creation: discipline, money, and time. If you can sacrifice just a little bit of today and you can create margin where that money gets applied over a long period of time, you get to impact how wealthy you want to be. Now, if you want to accelerate that because you said, I think I can be free in my 60s, but what if I want to do it earlier? Then you just have to really ramp up that discipline part. Maybe instead of having a 25% savings rate, maybe you want to save 30%, 35%. Maybe you figure out how to get your expenses low enough that you're able to replace those expenses much earlier in life. That's the entire idea behind the FIRE movement. So don't think that to be wealthy and to be able to live life on your own terms, you have to go start, create, build something. If you can just go earn an income, sacrifice a little bit of today for a better tomorrow, you'll be amazed at how hard that money can work for you.
Yeah, I mean, I love it. I mean, it's one of those things where just be purposeful, because the sooner you can, save and invest and have financial independence, so you work for the joy of it versus the obligation of it, I think you'll be happier. But I love this because, Jacob, every business, I don't care the size, they're looking for people to come make their mark. So go make your mark. And then let me go ahead and tell you the rest of the story. I love when we do that survey, is because just like I had my path into seven-figure, now I can look at it, and yes, there are multiple streams. That happens. That's where the complexity of where the abundance cycle fulfills. Just find your path. It's okay to be an entrepreneur at a company or a business. And then those other streams, you're going to notice your portfolio will start creating income. You might inherit some assets or something, or you move out of a house and it's, one becomes a rental property. That stuff all comes. You just got to chart your path and grab the opportunity to maximize and create the best version of yourself, because there is a better way to do money.
I love it. That was a fantastic question. Thank you so much, Jacob. All right, Brian, here's our next one. This question is from Caleb. Caleb says, how do you overcome the feeling that you aren't doing enough? I have a little girl on the way. Congratulations. We're saving 23% of our income. Any pointers from you parents on self-assurance strategies? And I think financial mutants, we always fall into this trap. We always think, man, I could do more. I could do better. I'm behind. I'm not doing enough. I'm not doing enough. I think achievers have that problem. So what are some things, Brian, being a high achiever, that you figured out early on that helped you say, hey, you know what, it's okay. I'm going to be all right.
Yeah, I think this is definitely a financial mutant skill, or it's a characteristic, is we're hard charging. A lot of people, and I've picked on Bo. I was like, Bo, sometimes slow down, enjoy the season of life you're in, because it moves fast. All phases, your 20s when you don't have a lot of money and you're kind of getting your start, and then your 30s, the messy middle where you got the family. Every decade or season of your life is going to have a different flavor, a different experience or memory and scars and other things that will leave on you, but it also will have a sweetness to it. So you got to make sure you slow it down to enjoy it, because that's a risk that us achievers struggle with. So how do you do that? That's really the question Caleb's asking, is because it's easy to say that, to enjoy the moment, but how do you actually, because us financial mutants, we're analytical beasts. We need to kind of know. And that's one of the reasons that, look, if you go to learn.moneyguy.com, we have the know your number. I have people all the time that, Caleb gave his age.
He did not. He just says he has
I had somebody else reach out to me and we had a good dialogue. They were in their early 40s. And they're like, my family's like, why are we doing vacation this way? Why are we being so cheap on all this other stuff? And I was like, man, you know, if you are in this position of abundance where you made all the sacrifice in your 20s and 30s and did it the right way, there is a moment where you need to start questioning yourself. Are you a miser with the way you're treating your resources, or are you a money maximizer or a financial mutant? Because there is a balance there in between. And that's why I love about the Know Your Number course, is that it's actually going to let you go put in your assets, your investment assets, let you play around with all the variables like inflation, rates of returns, as well as your goals of when you want to retire or have financial independence, or at least the option to retire. And then you can start, running the 3D plans. You can do the dream plan, you can do the down-to-earth plan, and then you can even do the do-do plan to, if things go really horrible for you. But Caleb, do that homework of that, and then once you figure out, hey, man, I'm in a really great situation, embrace that to be your freedom to start enjoying life. That's what, and I know that's what you were alluding to, Bo, is that I did have that discussion with my wife back in our 20s. I was like, if we can save really strong, in a way that others are not doing it, we're going to be able to make choices that others will dream about, go on vacations and do, because we did the heavy lifting earlier. Make sure you're being respectful to all those different stages.
I love that, Brian, and I agree with that full fold. Caleb, and by the way, Caleb came in and said he was 29. He then took that back and said he's 33. So I don't know how old he is. If y'all think I don't see the chat, I'm in there with you.
By the way, Caleb, if you're having insecurity about saying 33 over 29, let me tell you, late 40s is going to kick like a donkey. It's going to be tough.
Here's one of the self-assurance strategies, because you said you're about to have a little girl on the way. This was so helpful for me and my wife early on. Nobody has this life figured out. Every parent who, you'll figure out real quick when you become a parent, holy cow, my parents didn't know what they were doing. And then even we as parents, what we try to do is we try to do the best we can with what we got. We try to do the best we can with what we got. That's true in parenting. It's also true in your finances. I mean, when I very first started working, when I very first began my career, I did not start saving 25%. But I started somewhere, and I did the best I could with what I could. And all I said to myself was, hey, I know I'm doing what I'm supposed to do. I'm moving in the right direction. I know I'm moving what I'm supposed to do. I'm moving in the right direction. And then we had kids. Every night we go to bed, we'd be like, hey, that kid survived today. Me and my wife, high five. Let's celebrate. And then we did it again, and then we did it again, and then we did it again. So no one has it figured out, and I think there is some peace that we can find in that. Don't worry about, am I doing everything perfectly right? Am I moving every situation exactly? That's why we do the financial order of operations. That's why we say, hey, if you can save 25% of your gross income, or if you can be moving towards saving 25% of your gross income, then you are moving in the right direction. Just breathe, relax, understand, hey, we're all on this rock together, moving in the same direction, and we do the best that we can with what we got. That's what I got.
Yeah, definitely lean into the financial order of operations though. moneyguy.com/resources, because it at least gives you the peace of mind that you've thought about all the different things. That's why the system was created.
All right, Brian, this question is from Ray, or Ree, but I think it's Ray. Ray says, hey, Money Guy team, my employer offers a variety of funds in their Fidelity 401k plan, and I was wondering what's the highest gross expense ratio you'd be willing to have? My options range from 0.3% to 0.1%. We get this question. I'm sorry, 0.3% to 1%. I said that wrong. We get this question all the time. Hey, because you hear us talk all the time. We love index funds. We love low cost. It's been a race to the bottom amongst a bunch of the big index fund providers. And so a lot of people, because they know that and they believe that, they start to get anxiety when they see anything that's not a bottom of the barrel expense ratio. So is the correct answer you don't ever pay a higher expense ratio? Or if you do, how do you know when and why, and does it make sense to?
Well, I mean, it's nuanced. I mean, because let's talk about different asset classes just as an example. Large cap. That's all your top 500 companies in the United States, the S&P 500. I'm going to be pretty upset if I'm paying 1% for that, because I know that there's index funds that charge me. I mean, Fidelity has a 0 fund, but a lot of funds, it's not hard to get 0.01, 0.02, which is still pretty close to free.
Yep.
So that's Ray. I ought to look at each asset class and think about, what am I getting for this? Large cap should be practically in the basement to 0. If you're paying a high fee on that, I would start questioning that. Is there a rate of return that's exceeding what the benchmark is doing to justify this? And the research from Spiva shows that over the long term, 80+% of managers don't
underperform.
They underperform. So that was why I try to beat the market when you can be the market, and just try to maximize the lowest cost option as possible. Now, there are the cases like we're in this weird interest rate environment with bonds. And look, I like bond index funds too, but I noticed we did our attribution analysis for our clients recently, and it was interesting to me that all the managers smoked the indexes. And that's because that manager was obviously playing around with the inverted yield curve, the choice of the different types of papers and other things that they were buying, because we're in a very inefficient marketplace with the crazy interest rates and all the other risks that are going on right now. So once again, I looked at the asset class and I said, okay, how does this compare to the indice? We're in this moment of weirdness that it looks like the manager is actually overperforming, and to the point that it well beyond what the cost is. That I'm going to be okay with paying a little bit extra on that. Yep. And I think you have to look at that on every asset class that you're doing. I mean, definitely the big ones, because you want to make sure that you got some diversification in there. Depending on what age you are and what your risk profile is and what your goals are. So that's the way I'd look at it. And then, Ray, I'll bring this back to it, because you said you have a Fidelity. Now, I'm surprised because you said you have a Fidelity 401k, but your lowest cost is 0.3.
That was very surprising.
That was because usually when I see Fortune 500 Fidelity 401ks, they are practically free on the internal expenses. And a lot of them offer the index target retirement fund, where those index target retirement funds with Fidelity, I know, are less than 10 basis points. So it's like 0.08, 0.07, depending on which one that you're looking at. So there are options even there. But I would just say, if I'm going to pay a fee, what am I getting for that fee, and how does that fit to the asset class that I'm investing in?
And then the other thing I would do is I would think about your total portfolio. So when we do portfolio analysis, we look at the total portfolio's internal operating expense. You just take your weighting times the internal expense and you figure that out, or you have a software that can help you do that. And then, just like Brian says, you sort of granularly work through each individual asset class and then each fund in that asset class. Now, we are of the opinion that a lot more of your return is driven by your asset allocation than the specific security selection. So understand, focus on the big things that matter, and don't get lost in the minutia. But I do think there's probably a little bit of room where you could improve your plan. You said it great, Brian. make sure you know what you're paying for and you're getting value out of that. That's one of the reasons we like you guys coming to check out this show. We want to make sure that you are getting value out of interacting with us. It's one of the reasons why we put together the shows. It's why we like to answer your questions. It's why if you go out to moneyguy.com/resources, we have a plethora of free resources available to you because we believe that there is a better way to do money, and our goal here at the Money Guy Show is to help you do money better.
Yeah, it was one of those things. I love doing these Q&A shows because I felt like there was a little bit of a theme that was running through there, Bo, and it makes me happy because y'all know I love doing this, and that's why I'll be hosting for years to come, joined by Mr. Bo Hansen. The rest of the team, last day for the intern, or last week for the intern. I don't want to leave it anytime soon, too early. But this is the big theme that I took away from today. You need to ensure that your money works harder than you do. I'm talking about your back, your brain, your hands. Make your money work for you. Money Guy team, out.